Well, shares in the US and Asia tumbled after the Federal Open Market Committee raised interest rates by 1/4 of a point in a widely expected decision. Well, for more on the fallout and what to expect as we close out 2018, I'm joined now by Peter McGuire of XM. Peter, thank you so much for joining us. What's your sense, what's the fundamental reason in your view why markets have tanked so much in the past couple of months? Of course, the fundamentals have not really changed that much, have they?
Well, Adam, I don't know. That is the $64 million question. Why have they tanked? If you put your mind back to, and I think that September was really a turning point. We had the peak of the market, I think, in the S&P around the, well, not the peak, but certainly the start of the fall came early part of September. And then you had the president, he had his midterms at the end of October. He called the market a sense of where the oil price was. He said that OPEC and the other band need to lower prices. He was worried about his elections, and since then you've seen a continual downdraft across asset classes. You've had a Fed not sure where it's going to go, in the sense that we're seeing 3 rate rises next year, or 2, or possibly 1, or are we going to see actually a reduction in interest rates? So it's such a mixed bag, and that's really only the start of it. I think 19 is going to be a harrowing year for many traders, and hold on to your hat.
But if we take a really big step back and we look at the valuations in the US and also in Australia, are they still expensive, or are they cheap enough yet, or what? I mean, how can we judge whether it's too expensive or not?
Well, I think if you're looking at the US first on board, if you look at that Sharpe ratio, and that's the, as far as risk-free and volatility, and putting that all into a ratio, 2017 was a standout, 3.2 versus a long-term average of about 0.7. So 17 was the best year for the S&P in the last 60. 18 is a different matter completely, and having a look at what's happened in December so far this year, it's been the second worst performing year since the 1929, the Depression, or it might have been 31, I'm not sure, but it's either one of those 2 years. So there are so many, if you're saying it's expensive, share buybacks are at all-time high in the US, interest rates are low, and things are on a good term basis if you're looking at the unemployment numbers. But if you're looking at a global positioning, I think there's many certain uncertainties, and that's going to create, I think, some further pain over the next couple of months.
Well, what about on the Australian market? What's your view there? I mean, if we stripped out, say, the financials, which of course have had a terrible year here because of the Royal Commission and various other reasons, I mean, has our market done as badly as the US if you get rid of all the bank stocks?
Well, it hasn't. If you put your mind back to late 2007, it hit nearly 7,000 points. It's now sitting at, what, 54, 5,500. That's not a good return on anyone's forecast. We had a and we're 30% from our high, and that's taken 11 years, and we're still a long way back. So I think that the US has certainly performed far greater than what we ever got any chance to, be a part of. And we're being held down and pushed down, to strip out those financials, across the mining sectors, and of course where China plays. China's well down, bid, nearly 30%, I think, for the calendar year. So that gives us a wake-up call, and then you've got all the other markets retracing. So I think Australia is going to be pulled further down. I'm not going to give you a headline number, but if it gets under 5,000, I wouldn't be surprised.
Yeah, you mentioned the Fed earlier and kind of the changing views about what they're going to do. I mean, do you think that their communication strategy is working? It seems to be a bit all over the place if they're having to send out Fed governors to give sudden interviews on CNBC to clarify their position.
Well, first off, I think the more important point is that in the last probably 48 hours, you've had a certain degree of an underswell there, whether Jerome Powell's actual position is safe and secure. And that's a little bit of banter coming out of the market. Mnuchin's going in to defend, the president. You've got the Fed, and they were all together on their last meeting, in the sense it was unanimous in their viewpoint as far as pushing that to the 4th rate rise for the calendar year. So there is no uncertainty, or there's no one on a different side of the boat. Where they run into 2019 is going to be a fractious year, because we've got Brexit, and that's very much an unknown. I was in London a couple of weeks ago, and the feel on the street there is one of very much pain. Then you're talking about Paris, and what's going on there with youth unemployment, the millennials, and all of that starting to really gain some momentum, and I don't think that'll stop for quite a number of months yet. and then you're talking about the Eurozone and where does China play. So there's a lot of big issues out there, and I feel as though that, it's going to be a very, very wild year for the Fed to try and gauge what they'll be doing in August or September next year and giving a viewpoint from here.
Well, just on Brexit, and the vote, I believe, in the House of Commons is the 14th of January. Is that the next big market-moving event for you, that vote?
I think there's even before that. Let's see what happens as far as that. That's certainly one in January that's got to be a great concern. But the other one is going to be, is the government going to be shut down in the US? Is President Trump and the Democrats, they'll be taking the House, I think, in the 3rd of January. Does he get his $5 billion for the wall? Does he shut the government down? It's a minute-by-minute proposition with the president. He's certainly not backing off. I think this week will be a very tumultuous week. I think there'll be pullbacks. Normally that Christmas rally is certainly, there's no chance of that. And it's going to be a tough, hard week and a grind out till the 31st of the month. If they shut the government down, I think that's going to cause a lot of pain, and I think that's going to really hit the Dow hard. You're probably down a couple more % over the next matter of 3 or 4 trading sessions.
Peter, just a question from left field a bit. I guess obviously we have so many self-managed super funds in this country, and they do invest in stocks, and as they'd be checking their returns kind of at the end of the year, they're going to be some pretty awful figures. Do you think that part of the collateral damage of a falling share market is it does shake confidence in the superannuation system that we have in this country?
Yeah, well, I mean, I'm one of those myself. I think everyone is very conscious as far as, their share portfolio. They watch it probably, as closely as they watch anything else. They'd be, living the heartbeat of it. The other thing I think that people have got to be very mindful on when markets correct, they've got to look at, shorting a market or at least hedging their positions. And that's not an unknown because, you either that or you sell your positions and you buy when it's cheaper. You've got to be responsible for your own situation if you're self-managed, and you're the master of your own destiny in a lot of ways. And that's if you're going to trade on your own behalf. So, it's very, very much a part of, having your hands on the wheel and realising the risk and looking at, alternates. Have a look at the gold market, have a look at, energy sectors, and keep aboard of, what's happening as far as the industrials and mining. And maybe you've got to look further afield, emerging markets or other markets that have got better growth frontiers.
All right, Peter, thank you so much for joining us this morning.